The two key metrics that go into valuing most businesses are profits and a profit multiplier. To value a business, you take the profits of a business and multiply this by a multiplier. Simple, right? Well, actually, no, not really. Working out what these two key metrics are isn't as straightforward as it appears on the face, as you need to establish what are profits and what is the multiplier. Please don't jump ahead yet, as it's important you understand the basics of how to value a business beforehand, but at the end of this video I'll explain the 4 most important things you should consider before entering into negotiations to buy a business, which are far more important than any business valuation method you choose. With that said, what I'm talking about here is the earnings multiplier method, which is based on the idea that a business's value lies in its ability to produce income or profits into the future. There are other methods to value a business, which include book value and the discounted cash flow method. But for the type of business I recommend you buy, I suggest you use the earnings multiplier method. Let me explain the profit metric of this business valuation method. Out of the two metrics, profits are the easier metric to calculate. For the purposes of this video, I'll run through the basics of this metric, which begins with where to look for profit for a business. To arrive at the profit metric for business valuation purposes, you get this from the latest set of accounts for the business, and profit can be found on the profit and loss statement. At the bottom of the profit and loss statement, you'll find net profit, which is your starting profit for business valuation purposes. But there are few factors to consider, which are: which profit figure should you use? For example, should the profit you use be before or after taxes? I recommend use profit before taxes, which is the most common approach to business valuation. Number 2, how many years of profit should you consider? Well, I suggest a minimum of 3 years, and better still 5 years. Number 3, how old are the latest set of accounts for the business? If the official accounts the company has produced for tax purposes are more than 6 to 12 months old, you may want to ask for the latest management accounts too, and include these in your valuation equation. Next, do you take an average of these profits over the last 3 to 5 years, or do you give each year a weighted average? I suggest you use a weighted average, especially if the profits have been fluctuating significantly over the period. It is better to give a higher weighting to the more recent years though. The next question is, are there any add-backs to profits? There are normally add-backs to profits, and an example of this is loan interest, where the loan is to be repaid as part of the business sale, which would include income streams that will cease after the sale, or if there are any sales lines that have come to an end in the later periods. Another example of a deduction from profits is interest income, on the basis that interest is not part of the business's actual value. Another question is, what about exceptional items? Businesses can have exceptional expenses and exceptional income, and both need to be taken into account when arriving at profits for business valuation purposes. Another question to ask is, what about business trends? You may want to consider profit trends, be it that profits are trending down or up. For example, if profits are on a downward trend, you may need to consider giving a higher weighting to the more recent years. But more importantly, is the business or the industry in which it operates becoming obsolete? What if the business is making losses? Well, in my opinion, unless you have good experience in business turnaround, or unless the loss was a one-off blip that can be explained, I suggest you do not buy a loss-making business, especially if this is your first business you intend to buy. Let's now look at the profit multiplier metric. The profit multiplier is far more subjective and is dependent on a number of factors and characteristics about the business and its owner. For the purposes of this video, I'm going to assume we are talking about a small business. And when I say small business, I'm still talking about $1 million business that is making six-figure profits of at least $100,000. The reason I choose $100,000 is because, in my opinion, you should only consider buying a business with profits of at least $100,000, as anything less than this, you are probably buying yourself a job, which is another story and for another video. With that said, you are probably looking at a profit multiple of around 3 times for many small businesses. Why 3 times, you might ask? Well, that's kind of an industry norm and is a very good starting point. In an example I'll come on to in a moment, the profit multiplier can be as low as 1 times profits, or it can be as high as 7 times profits. But again, in my opinion, it would have to be a very special business to pay 7 times profits, or the business will probably be a much larger business or a publicly listed company, which in this case is not the type of company I'm talking about in this video. So if you find a business with profits of $300,000 using a 3 times multiplier, this business could reasonably be worth $900,000. There are a number of characteristics that affect this multiplier, and in my opinion, there are 2 key characteristics you should consider, which are the level of dependence the business is on its owner. The more a business is dependent on the owner, the less it will be worth to the buyer, which means the multiplier reduces, whereas the less dependent a business is on its owner, the more valuable it will become, and therefore the greater the multiplier. The second characteristic is the level of dependence on 1 or fewer large clients. The more sales of a business that comes from 1 or a few large clients, the higher the risk. This is because if you buy a business that has, let's say, 1 large client, where the sales to this 1 client represent, let's say, 80% of sales, if the business lost this client after you've bought the business, the company will probably go bust. I would therefore recommend you steer clear of companies like this, or at the very least take this into consideration when arriving at your profit multiplier. As an example, a business I found when I was buying my own $1 million business, I agreed a 1 times multiplier with the owner. In this case, the business had sales of over $3 million and profits of over $600,000. The owner agreed to sell his business for $600,000, which is what I offered after asking him the questions I include in my business buying checklist, which revealed that the business was dependent on him and, in my opinion, influenced the multiple. Earlier in this video, I mentioned about the 4 most important things to consider prior to entering into negotiations to buy a business, which are: the true value of any business is when a willing buyer and a willing seller meet in the middle on price. No matter what its profits are, no matter what multiplier you choose, and no matter what factors or characteristics you consider, which is not too dissimilar to how property values are perceived, because the true value of any property is what a willing buyer is prepared to pay and what a willing seller is happy to accept. The next thing to consider is that buyers of businesses tend to look at historical data, which is its past financial statements for the last 3 to 5 years, whereas sellers of businesses tend to look forward and sell the future of a business and its potential. If the gap between these two ways of thinking is too large, it's unlikely a deal will be agreed. The next point to consider is that the business for sale market is a buyer's market, as there are way more owners looking to sell their businesses versus people looking to buy them, which means that buyers usually have the upper hand in negotiation. The final point to consider is that the deal struck must be a win-win for both parties. And if you always take the above four things into consideration when you approach the negotiation stage of buying a business and a business's valuation, you won't go too far wrong. And always keep point 4 in mind, as no negotiation will ever work if either party at the negotiation table feels the offer isn't a win for them.